What's up, money lovers? Just want to give you guys a quick update on Stag Industrial stock. This is one of the 3 REITs that I own, the other 2 being Realty Income and RioCan. Made videos on all 3 in the past. You can definitely check those out on the channel. So Stag is an industrial REIT, and they do a lot of work with e-commerce, and they just reported earnings last week. We'll take a quick look at their earnings report and some strengths, I think, that I see with this company and why I think it's a great buy and hold for the long term. Their occupancy rate came in at around 97%, and they had a 77.6% retention rate on the leases that were expiring in the fourth quarter. We'll talk more about that retention rate in a second. Now, if we look here, their core funds from operations, this is probably the best way to measure. REITs kind of gives you the most accurate picture, and when we'll look at the price to funds from operations to value this company here. As you can see, from 2020 to 2021, their FFO increased almost 20%, 19.2%, from $288 million to around $344 million. And if we just take a quick look, their price to funds from operations, so this is like if you were to look at the PE ratio for regular companies, this is a better measure for REITs. Their stock price, $38, divided by their funds from operation, which is around $2 a share. Stag's price to FFO is around 19, and you compare that to a Realty Income. Realty Income's price to FFO sits around 20. Here's a look at their acquisitions for the fourth quarter. This is a company that operates all over the U.S. They're very diversified by geography, as you can see here. Got some locations in many different states. So in 2021, they added 74 new buildings consisting of around almost 13 million square feet. And the average lease term they signed was about 6.7 years. So this is another thing I like about this company. They sign these long-term leases, so there's not a lot of turnover every year. And as we said earlier, they tend to have a pretty substantial retention rate as well, which I think further adds to their strengths. And their cash capitalization rate, 5.2%, meaning they expect to make around 5% on the investment here. For 2021, they added 29 new leases and they renewed 66. So their lease renewal rate or their retention rate was around 76.6%. Now with REITs, they do tend to dilute you a lot, and they did a new offering, a lot of shares here of 9.2 million shares. But that's just something that comes with REITs. But if the REIT is managed correctly and efficiently, over time, it does pay to own it because you will still get some capital appreciation. And with a company like Stag, you're getting a monthly dividend as well. So Stag is a company, speaking of dividends, that has 9 years of consecutive dividend increases. You can ignore the payout ratio as it's not an accurate measure for REITs. REITs are required to pay out over 90% of their earnings to shareholders, but the dividend comes out to about a 3.77% yield or $1.46 per share per year. So if you divide that by 12, you're getting about 12 cents per share each month from Stag. And if we look at the stock chart here, you can see the stock's actually down pretty significantly year to date, down 17%, kind of just moving with the broader market. And I think under $40, Stag is a buy here. It's definitely a position I'll be adding to and holding for the long term. So another thing I really like about Stag is that around 40% of their portfolio handles e-commerce activity, which if we look at the chart, e-commerce is something that's incrementally increasing each year, obviously, as a percent of retail sales in the US. It had a big spike in 2020 with COVID, and it has since come down a little bit, but I expect this trend line to continue gradually increasing over time, and that's where Stag is getting around 40% of their business from. So there's a huge total addressable market here for Stag. The US industrial market is around $1 trillion in total size. So Stag has a long runway for continued growth. Their top 10 tenants here, as you can see, I'll zoom in a little bit. Amazon is the number 1 tenant, but it only makes up 3.8% of their portfolio, so it's not like they have too much exposure to one company, which would be something I'd be careful about. These are very stable tenants, as you can see, 53% publicly rated, 84% have revenue greater than 100 million, 60% revenue greater than 1 billion. So these are companies that are not going away, and it's good to see that Stag tends to have a high lease renewal rate, which I also like. This presentation is from back in November, so their FFO multiple was around 21 back then, so it has come down versus their peer average, which sat around 36. When we also compare Stag to its peers, they have a higher cap rate, as you can see, which means that they expect to get a higher return on their investments. So however much they spent to acquire that real estate property, let's say that they expect to get 4 to 5% in income annually versus the peer average, which is lower. So it just goes to show you the advantages you get with Stag. Very well run company, very efficient. And if we take a look at Stag's funds from operations here, you can see these first 2 columns. First column is just the trailing 12 months, so this is both really just 2021. And as you can see, it's steadily increasing each year, and it's actually doubled really in the last 4 or 5 years. So So this is a company that continues to grow and increase their dividend. I think it's a great long-term hold. Let me know what you think of Stag in the comments below. If you enjoyed the video, don't forget to like and subscribe, and let me know what other companies you're interested in learning more about. This is Vinny from the Investment Club, and I'll see you next time.